Shocking. Why Wall Street just bought your city's revenue. The meters started blinking red all at once. Chicago had rolled out new rates overnight, and people thought it was a glitch. It wasn't. A private company now controlled every quarter, every tap, every minute of curb space. In exchange, the city got a $1.16 billion check. Investors were staring at projections north of $10 billion over the lease. 75 years. That's longer than most of our lives. And here's the kicker. Close a street for a block party, at a bike lane, the city owes them. So who owns your city's money tomorrow morning? Not you. Let's rewind. The city cash crunch machine. Sit in the budget room on a gray Monday. Pension bills are due. Debt service eats first. Roofs leak. Pipes break. Buses need engines. The spreadsheet bleeds red. Easy options are gone. How we got here fast. Decades of tax caps froze property taxes. Federal support shrank. Borrowing costs crept up, and every downgrade hiked interest. Then the Great Recession slammed sales and property taxes in the late 2000s. Tomorrow money shrank overnight. Cities deferred fixes. Skip a patch this year, pay triple later. Deferred repairs became emergencies. Emergencies drained rainy day funds. Now every storm is a flood. Line items don't bend. Police and fire are people. You can't cut half a firefighter. Pensions and debt covenants are locked. Parks, libraries, transit looks small but cuts land loud. So the flex is what people love, and the repairs you skipped. Then suits show with oxygen, infrastructure funds. Unlock value, they say. Turn assets into upfront cash. They'll optimize, raise rates a little, add tech. You get billions now, they take collection risk later. Win-win, right? Here's the real math. Parking, tolls, water, long, steady rivers of cash. Monopoly must pay, inflation-linked. Catnip for investors, hunting stable yield. Borrow cheap, lock fees to inflation, stretch decades, present value explodes. So they wave a big check. From the mayor's chair, that check avoids layoffs, keeps lights on, saves an election. You fix today's headline and punt the tail. Value doesn't vanish. It moves from your block to their balance sheet. The fine print prices policy. Lease 75 years, you lease choices. Add a bus lane where meters lived, pay lost revenue. Freeze fees in a recession. Change in law can bill you. Can govern if you pay. The beats repeat. Step 1. Crisis slide with a scary gap. Step 2. Market sounding that pre-writes options. Step 3. Roadshow where private capital sets the rules. The more you need money, the less leverage you have. Advisors get paid at close, not for lifetime value. For people, higher bills hit before better service. Escalators start day 1, upgrades lag. Libraries trim hours. Potholes wait. 911 times creep. You don't vote on fine print. You get a bill. Alternatives aren't painless. Taxes are a hard sell. New bonds add debt. Cutting benefits triggers lawsuits. Doing nothing breaks stuff. Asset monetization sounds like middle ground. It's not. It swaps tomorrow's predictable money for today's one-time cash. Your grandkids still pay, but their money flows to a fund in New York, Sydney, Toronto, or Abu Dhabi. And once you do one deal, budgets rely on fees you no longer control. Parking drops, you might owe the operator. A pandemic clears streets, force majeure carve-outs still spark fights. Heads, investors win. Tails, they negotiate. So cities keep doing it because the gap is real and time makes it worse. Inflation lifts wages and asphalt. Ratings watch pensions like hawks. Markets jumpy. Refinancing spikes. The biggest check starts to look like the only door out. This is the cash crunch machine. Pressure in, options out, contracts lock. To see it in the wild, look at the blueprint, Chicago's parking meters. Let's walk through it next. Case Study 1, Chicago's 75-year parking meter deal. 3 days in December 2008. Thick ordinance Tuesday, briefing Wednesday, vote Thursday. 40-5. Chicago handed control of 36,000 meters to a brand new company for 75 years. Check. $1.16 billion. People thought it fixed things. It didn't. Other side. A Morgan Stanley-led consortium with Allianz Capital Partners and the Abu Dhabi Investment Authority. They formed Chicago Parking Meters, LLC right before close. New shell, serious money. Their math. Projections north of $10 billion over the term. By cash flows cheap, lock rising rates, let time work. Why sell low? Speed, pressure, bad assumptions. A steep discount rate, short horizon, thin credit for tech upgrades. The Great Recession cratered revenues. City Hall needed cash now. Consultants said market value. The market said steel. The contract was Tripwire City. Close a street for a festival? Pay true up for lost hours. Add a bus or bike lane that removes spaces. Pay. Convert to loading? Pay. Construction and broken meters triggered math too. Policy events, routine repairs, each could spark an invoice. You can govern, but you pay rent on your own curb. Rates jumped fast. Coins to pay boxes to phones. No grace minutes, tighter enforcement. Collections surged by design. The operator invested in gear that turns minutes into money. Prices rose on a schedule tied to inflation and pre-agreed hikes. Households felt it. Lunch crowds felt it. Budget side. Most of the $1.16 billion plugged deficits and short-term debt. A reserve got tapped later. A few years of relief, then the same gaps, pensions, maintenance, ops. But the city had traded away a steady stream that could have helped. Sugar high, then crash. Backlash was loud. People hated the speed, the spikes, the ironclad terms. Lawsuits flew. Unwind it. Not really. Termination penalties were massive, lenders were lined up, and tweaks took years. By the early 2020s, investors had recovered principal and were hundreds of millions into profit. 60-plus years still to go. Micro moment, a neighborhood block party. Permits okayed. Then an invoice, pay for each metered hour lost. That bill used to be zero. The choice, cancel or fundraise to cover curb rent. That's a balance sheet on a sidewalk. The real loss was freedom. Remove parking to add bus-only lanes? Each lost meter costs. Outdoor dining in a crisis? Same. The deal didn't ban moves. It priced them. Tight budgets turned price into veto. Finance took notes. The deal became a roadshow slide. Stable, inflation-linked, must-pay revenue, rate latitude, enforcement, legal shields. Template portable. If meters monetize, so do tolls, airports, water, sewers. Chicago was the test. Returns made it a billboard. Could it have been better? Shorter term, revenue sharing above a baseline, more time for bids, and carve-outs for festivals, bike lanes, transit. But the clock and incentives pushed speed. Advisors earned success fees at close, not on lifetime value. Bigger lesson. Long leases don't just privatize cash, they privatize choices. Councils inherit contracts, not clean slates. Ideas hit a spreadsheet first. If compensation kills the line, the idea dies quiet. By the time the math was clear, the river had changed course. Money that once washed into parks, libraries, buses now flowed to funds far from the curb. Meters kept blinking. Invoices kept coming. Then the template moved to bigger pavement. Parking was the pilot. Toll roads were the rollout. The toll road gold rush. While Chicago's meters printed money, the big game moved to highways. Must-drive roads with toll booths that never sleep. First big splash, Indiana. In 2006, the state took a $3.8 billion check for a 75-year lease of the 157-mile Indiana toll road to a Sintra, Macquarie joint venture. Quick cash and a promise, private know-how, better service, predictable tolls. Under the hood, toll escalators baked in, some tied to inflation, some on an annual schedule. Revenue pointed up even if traffic was flat. For drivers, higher tolls like clockwork. For investors, a bond-like stream with a ratchet. With that floor, operators levered up, paid early dividends, and refinanced when credit was kind. Leverage cut back. Traffic lagged, debt costs bit. In 2014, the operator filed Chapter 11. Headlines screamed failure. But the model held. In 2015, IFM investors paid $5.73 billion for the same lease. The road didn't change. Cash flows got repriced up. Public saw collapse. Finance saw mark-to-market. The Chicago Skyway echoed the logic. Pay big, raise tolls within caps, rework debt, skim the spread. If you borrow cheaper than the road earns, you pocket the difference. CPI-linked tolls keep pace. Not sexy, just math. Drivers felt the grind. Prices crept, transponders replaced cash, late fees got sticky. Miss a toll, get letters, then penalties, then suspension risk. Thin budgets had no way around it. You need work. You pay the gate. If you can't, the meter runs against you. Freedom traded for cash. Divert trucks to cut neighborhood noise? Non-compete can trigger payouts. Cap tolls in a recession. Change in law claims. Even lane closure planning becomes a negotiation because closures shift hourly revenue. Policy isn't banned. It's priced. Bankruptcy didn't end the story. It reset it. The road stayed open. The contract survived. Lenders took a hit. A new investor stepped in at a higher valuation. The state kept the first check and the locked terms. Little incentive to rethink. The market learned. Tolls are durable through storms. Microstory. A nurse in Gary works nights. 2 plazas a day. In 2006, a few bucks. By the early 2020s, hikes pushed her monthly tolls past her phone bill. Groceries tighten. A birthday dinner skipped. The gate still gets paid. That's must pay on a fridge. Calendar. The sales deck toward state houses. Monetized today, billed tomorrow. Undermanaged roads, optimized ops, transparent rates. The real engine. CPI escalators, heavy leverage, refi optionality, legal shields. Heads, you harvest. Tails, the asset trades up. Better structures? Yes. Shorter concessions. Share revenue once returns clear a hurdle. Hard caps on escalators. Clawback refinancing gains. Real KPIs, not shiny restrooms. Public finance options over one-time jackpots with strings. This wasn't a one-off. It rolled out a model built on patience and pricing power. Investors brought a 40-year clock, governors a 4-year one. Same as meters. The highest cost wasn't only higher prices. It was losing freedom to steer without cutting a check. Water, sewer, and the bill you can't skip. You can dodge a highway. You can't skip the tap. That's why private equity loves pipes. Monopoly service, must pay bills, inflation passed straight to you. Cash flows even in recessions because people need to drink, flush, shower, cook. Miss a payment, and the shutoff notice has teeth. See Allentown, Pennsylvania. After the Great Recession, pensions climbed fast. In 2013, the city leased water and sewer to the local authority to plug a pension deficit. Upfront cash now, future rate power moved to a contract. Within years, double-digit increases hit. Not a glitch, a feature. Why spikes? Steady escalators plus capital recovery charges. Cities deferred maintenance for years. Private operators inherit worn pipes, then upgrade plants, mains, meters. Those costs flow into your bill as capex recovery, sometimes with a return. Yesterday's deferral becomes today's surcharge. Enforcement is stronger than tolls, shut-off power. Collections jump when your tap is on the line. Late fees stack. Payment plans add admin charges. It turns a basic service into a prime receivable. Service disputes live in the contract. Brown water, boil orders, backups. Penalties may be cheaper than fixes. Operators point to compliance. Cities point to promises. Meetings become spreadsheets with lawyers. Microstory. A diner owner on Hamilton Street. A winter main burst kills morning pressure. Coffee machines stall. Breakfast crowds thin. The crew shows in the afternoon. He loses a day, then sees a capital adjustment on next month's bill. He pays. You can't fry eggs without water. Climate adds cost. More storms, overflows, treatment needs. Resilience, bigger pipes, green infra, backup power matters. Under private control, it's a decades-long revenue engine via tariff formulas. ESG wraps it nice. Math still lands on your table. Equity risks hide in base fees. A retired couple pays the same fixed charge as a big home before a gallon flows. Miss a month, fees pile up, a door tag warns shutoff. The city hotline can't help, contract rules. Terms are sticky. Change in law clauses can bill the city for lifeline protections. Winter shutoff moratorium? Claim. Leak forgiveness? Claim. Policy isn't banned. It's priced again. Funds pile in because demand barely moves in recessions. Inflation bumps, tariffs adjust. Debt loves the stability, so operators lever up, pay dividends, and roll maturities. If rates rise, they push more into riders and base hikes. It's the toll road model without traffic risk. Better paths. Public-public partnerships paired with low-rate state revolving funds. Shorter concessions with clawbacks above a return hurdle. Real KPIs, outage minutes, leak loss, auto credits. Lifeline tiers that cut base charges for low users. Transparent audits and open data. Truth, public control doesn't make leaks free. But when the city holds the lever, councils balance price and policy without a termination invoice. They borrow cheaper than private equity's hurdle and choose equity over extraction when storms hit. Allentown's lesson isn't no investment. It's better terms. When yield drives design, your bill is a profit plan. When stewardship drives design, your bill is a public choice, argued in daylight. The water flows either way. The question is where your money goes. The rise of shadow banks in city finance while pipes and tolls turned into yield machines, something quieter slid into City Hall. Lenders you don't see on Main Street. Not big local banks. Private credit funds. Infrastructure debt shops. The shadow banks. They don't take deposits. They raise money from pensions and endowments, then write loans that look simple on paper and heavy in the footnotes. Cities started calling them when bond markets got picky and timelines got tight. Here's why they're attractive in a panic. They move fast. No months-long roadshows. No retail buyers to convince. They show up with a term sheet that says we can close in 30 days. But flip the page and the price of speed shows up. Revenue-backed loans tied to a single stream. Parking, solid waste fees, water taps, even court fines. Covenants that kick in if revenue dips. Step-up interest if rating slips. Prepayment penalties so steep you're married to them longer than your mayor's term. A budget director in a mid-sized city told me how it lands. Sales tax came in light. A bond refunding fell through. Payroll was days away. A private credit fund slid a proposal across the table. A $150 million loan secured by sanitation fees, senior to other claims, with automatic sweeps from the lockbox before a dollar touched the general fund. The rate? A few points above muni bonds. The catch? Call protection for a decade and covenants that forced rate hikes if coverage fell. She signed. "Trust me on this one," she said later. We felt cornered. Meanwhile, something else was happening in the back office. Fees that used to be paid and filed, parking tickets, camera fines, court costs, got bundled. Securitized. Think of it like a box of IOUs from thousands of drivers and defendants, turned into bonds and sold to investors hunting yield. Structure promises steady cash because late fees and penalties fatten the stream. If collections lag, servicers add pressure. More letters, boot trucks, credit reporting. It's clean math for a spreadsheet. It's a mess for a single mom juggling 2 jobs and a busted taillight. Shadow banks didn't stop at fees. They pushed pension obligation bonds, borrowing to invest. The pitch goes like this. Your pension is underfunded. Your expected return is 7%. Muni rates are 3 or 4. So borrow cheap, dump it in the market, earn the spread. It works until it doesn't. If markets dip, you owe debt service and still have a hole. Rating agencies warn, but advisors earn success fees when deals close, not when retirees get paid in 2040. Optimism bias creeps in. The spreadsheet wins again. Ratings matter here. A downgrade on the general fund can shove a city toward these private deals. Traditional muni buyers want clean coverage and simple liens. Shadow lenders accept hairier structures if they get control, lockboxes, flow of funds waterfalls, springing reserves. Miss a test, and the loan rate steps up automatically. Miss again, and the lender can force rate increases on the pledged revenue or sweep more cash. You don't feel it at City Hall first. You feel it when your trash bill and parking fines jump in sync. Here's a micro-story. A college kid racks up 2 camera tickets and forgets to pay. The city sold a slice of traffic fine receivables into a trust. The servicer flags the account, slaps on late fees, boots the car. He pays the tow plus fees on a credit card. 3 months later, he sees a ding on his credit because the account rolled to collections before his payment cleared the trust's monthly cycle. 1 streetlight, 1 camera, 1 missed email, and now his rent costs more. Meanwhile, advisors and rating analysts often live in the same small circle. Consultants model demand with rosy assumptions. Lenders underwrite to strict covenants to hedge that rose. The city sits in the middle, relieved to close, unaware that they just pledged next decade's wiggle room. Unknown to them across town, the council is debating a transit fare freeze. If the bus system's fare box is pledged under a revenue-backed note, that freeze can trigger a default test. Suddenly, policy is a spreadsheet alert. Pension obligation bonds deserve one more beat. Their leverage, plain and simple. If you borrow $1 billion and the market returns 8% for 5 years, you look like a genius. If it drops 20% in year 1, you're underwater while paying fixed coupons. That pressure pushes cities toward more creative revenue pledges to keep ratios pretty. It's a quiet loop. debt to fund investments, then debt to fund debt. So why do shadow banks flourish here? Because they solve real timing problems and price risk with terms, not headlines. City leaders prefer pain tomorrow. Funds prefer control today. The spread lives in that gap. And traditional banks? After the 2008 crisis, many pulled back from complex municipal lending. Private credit filled the lane. Could cities push back? Yes. Standardized term sheets. Then pledging basic fines and fees that drive regressivity. Use state revolving funds and public banks for bridge loans with transparent costs. Demand independent valuations without success fee bias. And publish loan covenants in plain English so voters see the strings. The larger point is simple. Even when you don't sell an asset, you can still sell tomorrow. Shadow banks don't need to own your meters to own your morning. They just need your lockbox, contracts that outlive mayors. So let's open the binder that really runs the city, the contract. This is where the lock-in lives. It starts with one line that sounds harmless. The city will compensate the operator for any action that materially reduces revenue. Translation: if leaders choose policy over profit, the budget writes a check. Non-compete clauses do the heavy lifting. Picture a toll road deal. If the state adds a free alternate route or upgrades a parallel highway that pulls traffic, the concessionaire can demand payment. Same spirit on the curb. Remove meters for a bus lane, festival, or outdoor dining, you owe true-up dollars for the hours lost. Governing isn't banned. It's metered. Then there's change in law risk. These clauses price politics. Say a council passes a rule to cap rate hikes during a recession, or mandates a winter shutoff moratorium for water. The operator can file a claim. Your law cut our revenue, pay the difference. Even well-meaning reforms become negotiable cash flows. You can help families, sure, but you'll pay twice, once in foregone fees, again in compensation. Mandatory arbitration is the next trapdoor. Disputes don't play out in public courts. They go to private panels, often in venues chosen by the operator when the ink was fresh. The rules are tighter, discovery is smaller, and the clock is faster. The city walks in with policy arguments. The panel looks for contract breaches and price formulas. It tilts leverage because speed and costs push settlements. Venue selection adds distance. If the contract says disputes sit in New York or London, your city's lawyers now travel to fight about your streets. Local voices shrink in rooms far from the block that pays. Residents show up at council, not arbitration. Meanwhile, meter revenue gets wired while the case drags. Force majeure used to mean acts of God. Now it's a field of carve-outs. Pandemic, civil unrest, emergency orders, operators test the edges. Did closures cut parking hours? Claim. Did curfews lower toll traffic? Claim. Governments assumed shared sacrifice. Contracts assumed cash neutrality. 2020 taught everyone who held the pen. The bill showed up even when streets were empty. Here's a microstory. A mayor rolls out quick-build bike lanes to cut crashes after a deadly month. Paint posts done in weeks. Safety improves. Then legal sends an email. The operator wants compensation for 27 removed spaces on 4 blocks. Price per hour, times days, times escalation. The mayor stares at the invoice and counts which crosswalks he can still afford. The sovereign ceiling sits on top. Cities promise not to legislate around the deal. They agree to treat the contract like senior law. Sometimes they even pledge that future councils will adopt ordinances to maintain revenue. That's heavy. It boxes elected leaders under a document they didn't vote for. It tells voters, yeah, you can elect change, but the term sheet gets a veto. What nobody knew at signing, because nobody wanted to slow the close, is how small choices lock big futures. A definition of material reduction. A formula for fair market compensation. An index for escalators, consumer price index versus a higher proxy. A look-back period for calculating lost hours. Each tiny word turns into real money later. Lawyers write regulatory chill like a footnote. It's not a footnote. It's a winter. If every good idea routes through a damages calculator, bold policy dies before the memo. Staff self-censor. We can't remove that lane, it'll trip a clause. We can't freeze rates, the lender will step up the coupon. That's how spreadsheets beat town halls. Investors aren't evil for using these tools. They're doing their job, protecting yield. The question is, who protects the public's freedom to steer? If the city wants flexibility, it has to buy it up front. That means shorter terms, cleaner outs, hard caps on escalators, and explicit carve-outs for safety, transit, festivals, climate emergencies, and lifeline protections. Write those in plain English. Don't bury them in annexes. Also kill the rush. Holiday votes and 48-hour turnarounds produce bad law. Mandate cooling-off periods, independent valuations, and full contract posting before any vote. Put change in law math on one page the public can read. If compensation is due, show how it's computed. Sunlight isn't theater. It's leverage. One more fix. Align advisor pay with lifetime value, not just closing. If consultants get success fees when a deal signs, you'll get speed over substance. Tie fees to benchmarks, customer satisfaction, service uptime, rate fairness metrics. Make advisors share the ride they sold you. Because here's the bottom line. Contracts outlive mayors. They outlive recessions. They outlive booms. They decide who pays when life happens. If you don't set the guardrails will set you. And every time you try to swerve, someone will send an invoice. The Midpoint crisis. Federal money didn't fix the trap. So here's where the story twists. The pandemic hits. Streets go quiet. Meters blink with no cars. Toll lanes empty. Water bills wobble as people lose jobs. Budgets fall off a cliff. Then Washington opens the hose. Relief flows. Cities breathe. Payrolls get saved. Transit keeps rolling. For a minute, it feels like the trap eased. It didn't. The cash was a patch, not a pivot. Relief funds were one time. Pensions weren't. Debt service wasn't. Deferred maintenance wasn't. Most contracts didn't bend. Escalators kept ticking. Change in law claims piled up as emergency orders cut revenue. Operators argued force majeure didn't cover every loss. Arbitrations opened. Even with federal dollars, the spreadsheet fought back. The city's checks landed. The future still belonged to the term sheets. Meanwhile, inflation woke up. Asphalt, steel, chlorine, over time, everything cost more. The consumer price index jumped, which meant escalators jumped too. For tolls tied to inflation, that was automatic. For water and sewer, tariff formulas pitched higher base charges and new capex riders. Residents felt it fast. The bill went up before paychecks caught up. Relief money softened the blow for City Hall. It didn't lower the invoice on your kitchen table. Refinancing got rough. In the low-rate years, governments rolled debt easy. Then rates rose. A city facing a bond maturity had to pay more to roll it. If its ratings slipped during the chaos, spreads widened. Private credit smelled it. Shadow banks showed up with fast money, revenue-backed, covenant-heavy. The temptation was real. Close in 30 days, live with strings for 10 years. Leaders took the deal because payroll beats theory. Private equity had dry powder. Billions waiting for distressed public assets. The sales pitch got a fresh coat, asset recycling. Sell one revenue stream now, rebuild a bridge, fix a park, upgrade a plant, repeat. Unlock value, fund the future, they said. Except the math was the same swap as before. Tomorrow's predictable cash for today's headline ribbon cutting, with escalators and covenants attached. The press conference felt good. The contract would outlast the podium. Let's drop into a room. A coastal city's budget chief lays out options. Pandemic aid closes this year's gap. Next year, pensions climb 7%. A big bond balloons. A water plant needs a new membrane system. A consultant slides a glossy deck. Lease a portion of curb revenue. Borrow against sanitation fees. Fold in a public-private concession on a garage, and boom, $1 billion today. The chief asks about change in law risk, termination fees, and escalators. The banker smiles and says, standard market terms. She knows what that means. Policy will be priced. Inflation didn't just raise prices, it raised conflict. Transit agencies wanted to cut fares to lure riders back. But if fare box revenue was pledged under a shadow bank note, a fare cut could trip a covenant. Legal calls finance. Finance calls the lender. The lender says no unless you add a fee elsewhere. Policy by permission slip. The city wanted to help riders. The loan ruled the hour. Pandemic curves also teased a dangerous idea. Remote work shrank downtown traffic and meter demand, so why not renegotiate old deals? Operators countered with claims. You change behavior with policy, pay us. Arbitration panels weighed formulas, not hopes. A few concessions tweaked hours and zones. The iron core, term length, escalators, compensation stayed. One-time federal checks bought peace, not power. At the neighborhood level, people felt the midpoint as a squeeze from three sides. Utilities up, tolls up, fines sticky, groceries and rent climbed. Wages lagged. A delivery driver added up his week. More gas, higher tolls, a new processing fee on a ticket he swears he paid. He grinds an extra shift to catch up. He's not mad at finance. He's mad that life costs more and nothing feels better. Investors read the same scene as proof. Revenues were durable even through a global shock. Toll hikes held. Water payments remained resilient. Courts reopened. Collections resumed. Risk was real, sure, but contracted protections worked. Dry powder moved faster. New funds pitched essential services and inflation-protected yield. Money followed the math, not the mood. So can a city escape once it starts down this road? Only if it trades speed for structure. Shorter terms. Hard caps. Lifeline carve-outs. Automatic profit sharing when returns clear a hurdle. Clauses that give councils true flexibility in emergencies without writing a blank check. Public banks and state revolving funds to replace shadow loans. And sunlight, post drafts early, force real bids, and holiday votes. Here's the quiet truth. Federal aid showed we can move massive money to save essential services fast. It didn't change who controls tomorrow's dimes. That lives in your contracts. If you want a different ending, you need different paper. Because the next pitch is already here, and the gap is still real. The only way out is to learn from the reversals we're about to see. Reversals, when buybacks and renegotiations go sideways. You'd think the fix is simple. Buy it back, rip up the bad paper, start fresh. Cities tried. The contracts were ready for that move. Termination fees sat like bear traps, complex formulas that stack future profits, refinancing gains, and make-whole premiums. The number lands like a joke. Only it's not funny. It's 9 figures, sometimes more. So leaders pivot to renegotiate. That's where the grind starts. Operator failures should give leverage. Sometimes the private side misses maintenance targets, blows response times, even trips debt covenants. You expect a reset on public terms. What happens instead is a second-round deal that moves risk, but hardens revenue rights. Lenders push to protect cash flow. New equity comes in with fresh capital but demands higher fees, tighter lockboxes, longer escalator runways. The broken promise turns into a stricter promise. Hidden liabilities pop like landmines when the city tries to unwind. Deferred maintenance isn't a line, it's a list. Valves that never got replaced, software that never got patched, bridges with joints past life. The private side says, "We priced this based on the condition you handed us." The city says, "You promised upgrades." Lawyers argue definitions while pipes leak. Add in legacy pension claims for workers spun off during privatization. If you bring those folks back, you inherit years of underfunded obligations. Suddenly, your buyback price includes yesterday's mistakes. Here's a microstory. A coastal town fights to take back a marina after fee hikes gut local fishing. The council votes yes. The operator pulls the lease and points to the environmental cleanup clause. 10 years earlier, a minor spill wasn't fully remediated. The contract says any buyback requires certified cleanup to a stricter standard. Price tag: millions before a single boat ties up. The town delays. The old rate stays. Fishermen pay spring rates through fall. Renegotiations also surface small legal hooks with big teeth. Venue rules force the city to argue in another state. Mandatory arbitration limits discovery, so the public can't see emails that might show the operator slow-walked repairs. The clock runs fast. Hearing dates compress choices. Staff run 2 tracks, serve residents today, prep exhibits tonight. Fatigue becomes a tactic. Politics gets ugly fast. The first administration signed the deal under a crisis frame. The second campaigns on fixing it. The third inherits lawsuits, higher fees, and a public that's tired of promises. Voters swing. Incumbents freeze. No one wants to be the face of a huge termination payment, but no one wants to defend higher bills either. So they aim for tweaks, waive a fee here, extend a grace there. The core escalators and compensation formulas survive untouched. Time favors investors because of how cash flows compound. Every month the city waits. The private side banks revenue and strengthens its negotiating hand. Every quarter the asset performs, the model proves itself. If rates fall, operators refinance and extract value. If rates rise, escalators kick harder. The longer the fight, the the smaller the city's practical options. That's the time value crush. It turns outrage into fatigue, then resignation. Sometimes buybacks do close. Then the second bill arrives. Systems that were run for yield need catch-up, spending for reliability. Crews need training on platforms the city hasn't used in years. Spare parts aren't stocked. Data lives in a vendor's cloud and costs money to export. The first 6 months look worse than the last 6 months under the operator. Headlines sting. Opponents crow. A hard-won public win reads like a loss on Facebook. Meanwhile, bond markets watch. Ratings analysts don't grade passion. They grade ratios. If a buyback drains reserves or spikes debt, a downgrade can follow. That pushes up borrowing costs, which eats the very savings you hope to gain by taking control. To steady nerves, the city pledges new revenue, often the same fines, fees, and rates residents thought would ease after the switch. It feels like whiplash. Here's where it gets even messier. Second-round operators market themselves as the fixers. They buy the distressed concession, promise better service, and deliver tighter enforcement to hit coverage tests. That means more boots on cars, faster shut-off clocks, stricter toll collections. The public sees a new logo and a harsher vibe. In a weird way, the first failure teaches the market how to squeeze cleaner next time. Could cities script a better reversal? Yes, but it takes patience and plain English. Build a termination reserve over years so the payment doesn't gut services. Bake audit rights into old contracts now, real-time data, not annual summaries. Pre-negotiate. Performance step-ins. If targets miss twice, the city operates while the operator keeps financial skin in. Write republic clauses that waive cleanup traps and hand over software, maps, and maintenance histories at a fixed price. And put buyback math on one public page. No annex gymnastics. But let's be honest. Most places don't stockpile cash or political capital for that kind of long play. They wait for a spark, a scandal, a brownout, a viral video, then move fast. The other side wrote the timeline. So the deal morphs, not melts. Fees dip for a season, then climb. Contracts tighten. The lesson lands cold. It's easier to sell the future than to buy it back. And every time you try, the meter is still running. Fines, fees, and the policing for profit pipeline. When assets get locked up and buybacks stall, the hunt shifts to something closer to home. Your mistakes. Tickets, court costs, late fees. It's the quiet revenue stream cities can crank without a vote. And when budgets are tight, enforcement gets framed as safety, but it behaves like finance. Start with how the pipeline forms. Councils raise base fines to deter. Then they tack on fees to cover costs. Miss a payment? Late charge. Need a plan. Installment fee. Want to pay by phone? Convenience fee. Each one is small on paper. Stack them, and the number turns mean. And because you can't hire infinite clerks to chase it, cities outsource. Private firms step in to manage probation, monitoring, and collections, then bill the person who owes. The public budget looks cleaner because the cost moves off the books. The bill doesn't vanish. It shifts to the poorest person in the room. Sentinel Offender Services is a good example. In many places, they handled misdemeanor probation, ankle monitors, drug tests, then charged user fees to the defendant. Couldn't pay. They extended supervision and stacked more charges. Judges saw compliance. Companies saw receivables. What nobody saw clearly was the trap. People on the edge turned a $200 ticket into a $1,000 saga, paid from rent and groceries. Here's a microstory. A warehouse worker gets a rolling stop ticket and a fix-it for a taillight. He pays the first late. The system adds a penalty. He misses court because his shift changed. A warrant fee lands. He gets on a payment plan with a private collector. They add a monthly charge. He makes 3 payments, then his kid gets sick. He misses one. The boot truck finds his car outside work. Tow, storage, reinstatement. He calls his mom. 2 paychecks vanish to buy back the right to drive to work. Meanwhile, dynamic enforcement creeps in. Not quotas on paper, targets in practice. Departments get told, we're short on the revenue line. Suddenly, camera zones expand. Ticket windows widen. Overtime goes to traffic details, not burglary follow-ups. Safety matters, no doubt. But when the budget counts on tickets, every yellow light looks like a fundraiser. Securitization sharpens it. Some cities bundle expected fines and fees into notes sold to investors. The promise is steady cash because penalties cushion dips. Servicers then lean hard to keep coverage ratios pretty: faster late fees, quicker boots, more credit reporting. Miss a ticket, and your FICO pays. That raises your car insurance, your credit card APR, your deposit for an apartment. A city's spreadsheet pushes pressure into your whole life. Civil asset forfeiture sits at the darkest corner. Agencies keep cash, cars, even small balances, alleging links to crime without a conviction. For departments that can spend seizures directly, the incentive gets perverse. It funds gear and overtime, but also erodes trust. People stop calling for help because they fear losing more than they'll gain. Courts become toll booths. Cost recovery fees fund clerks, public defenders, even courthouse maintenance. So the house charges you for the room where it judges you. If you're poor, a public defender might save you from jail, but leave you with a tab you can't carry. Miss one payment, and a bench warrant turns a debt into a night in lockup. Employers don't love that call. Kids don't love that wait. Let's be honest. Leaders don't wake up saying, "Let's punish the poor." They wake up staring at a hole. This pipeline looks like free money. No tax vote, no bond rating call, just user pays. And consultants slide a deck with optimizations. Better cameras, new license plate readers, outsourced collections, private probation, fee schedules that align with peers. The ethics melt under the math. There's a race angle you can't ignore. The same neighborhoods over-policed for decades get the cameras, the checkpoints, the towing routes. Fines land hardest where margins are thinnest. A suburb with 2 cars per driveway shrugs off a parking ticket. A renter juggling shifts and childcare gets a stack of penalties that tilt a life. Could cities flip the script? Yes. First, wall off policing from revenue goals, ban quotas, bar budget. Lines that presume ticket dollars. Second, kill user-funded justice by prohibiting private probation and shifting court costs to general funds. Justice is a public good, not a subscription. Third, cap add-on fees and erase compounding. One fair fine, one simple plan, income-based when needed, no interest snowball. Fourth, stop securitizing fines. Don't turn human error into a bond. Also fix the root traps. Replace broken streetlights and repaint crosswalks before you deploy cameras. Offer real amnesty windows and on-ramps. Community service, sliding scale payments, automatic forgiveness for minor balances after clean months. Publish enforcement heat maps so people can see if safety just means revenue. A final microstory. A city held a debt clinic at a library. People lined out the door with crumpled notices. Volunteers untangled accounts, wiped junk fees, set plans that didn't break budgets. A mom left in tears because a stranger treated her like a neighbor, not a ledger. The city wrote off pennies on paper. It bought back trust worth more than any ticket roll-up. How deals get sold and sealed. To see how this keeps happening, watch the playbook run in real time. It starts with a drumbeat. Crisis framing. A consultant drops a glossy deck with a 5-year cliff and a red wedge labeled structural gap. The wedge is big. The colors are loud. The mayor nods because the gap is real. The room shifts from "what should we do" to "how fast can we move." Next comes the study. It looks neutral. It isn't. Scope is destiny. The consultant defines options that point to monetization. Asset inventory, market sounding, value unlock. The phrases sound harmless. Early calls go to a short list of funds already circling. The study discovers what those funds said on those calls. The loop closes before the public hears a word. Then the roadshow. Bankers book a day of meetings in glass towers. The pitch to investors is blunt: monopoly revenue, inflation escalators, ironclad contracts, friendly arbitration, upside from tech upgrades and stricter enforcement. The pitch to the city is softer: partnership, modernization, customer experience. Same deal. 2 languages. Valuation games do the heavy lifting. Set a steep discount rate, the present value shrinks. Trim demand growth to look prudent, then quietly add rate hikes that more than offset it. Treat future tech as cost, not revenue booster. Ignore the option value of policy control. Suddenly, 75 years looks like a bargain. You can move $1 billion price with 1 decimal on a rate. Forecasts get optimized. Traffic models assume elasticity. Drivers grudgingly pay rising tolls. Parking demand stabilizes, even as transit improves. Water usage flattens, but base fees rise to guarantee coverage. Every line whispers the same thing. The stream is steady, the risk is managed, the yield is yours. The spreadsheets smile. Stakeholder theater kicks in. 3 hearings midweek at 2 p.m. Slides run long. Public comment runs short. We appreciate your input. Lands like a period, not a plan. The calendar does work too. Holiday votes, lame duck windows, end of fiscal pressure. The clock beats the crowd. Sweeteners smooth edges. Year 1 freeze on rates. A community fund, seeded with a small grant. A promise of new kiosks and an app. Balloon escalators hide behind the freeze. By year 3, the curve steepens. By year 10, nobody remembers the ribbon cutting. They remember the bill. Advisors line up with success fees. Close the deal, get paid. Bigger the deal, bigger the check. Nobody gets a bonus for walking away. No one gets a medal for saying the price is low. The incentives lean on speed. The public's leverage leaks out of the room. Legal terms are salted in like spices you can't taste until later. Non-compete here, change in law there. Arbitration venue over there. CPI escalator, not a lower index. Step-in rights for the lender, not the city. Data access on request, not real-time. Each one tiny. Together, a cage. The sales craft hits human notes too. Jobs, local vendors, minority-owned contracts. They'll staff a call center in town, hire a few crews, sponsor a little league team. And sure, some of that lands. But the main cash still flows out through a lockbox to debt and dividends. The headline says partnership. The footnote says priority of payments. Meanwhile, opposition gets labeled anti-growth. If you ask for a longer bid period, you're risking the window. If you want a public bank option, you're ideological. If you question the discount rate, you're academic. The pressure is performative. Be a doer, not a doubter. Leaders fold because the gap is real and the calendar is cruel. Microstory. A council member asks for the full model, not the summary. Bankers say it's proprietary. She asks for the raw meter data. The operator-to-be says after close. She asks for the arbitration rules. Legal says standard. She votes no. The deal passes 40-5. 2 years later, her district pays for a block party permit because of lost meter hours. She keeps the invoice pinned above her desk. This isn't magic. It's muscle memory. Step 1, paint the cliff. Step 2, pre-wire the options. Step 3, sell 2 stories at once. Step 4, price the future with friendly math. Step 5, rush the clock. Step 6, sweeten the first mile, steepen the rest. Step 7, pay closers to close. Step 8, lock the law. Could cities flip the script? Yes. Start with sunlight. Post draft terms and red lines 30 days early. 1-page plain English summaries. Escalators, non-competes, change in law math, arbitration venue, data rights, termination fees. Demand true independent valuations, paid flat, not by close. Force real auctions with time for counterbids and a public option from state revolving funds. Write clawbacks and profit sharing. If operators refinance and harvest gains, the city gets a cut. If returns clear a hurdle, rates step down or checks flow back. Carve out policy freedom. Safety lanes, festivals, lifeline. Protections, climate emergencies. Cap escalators below consumer price index in downturns, not above. Put data in the contract. Real-time dashboards the public can see. Finally, align incentives. Pay advisors for lifetime value, not signatures. Tie operator bonuses to outage minutes, customer credits, and equity metrics, not just revenue. And ban holiday votes. If the deal is solid, it can stand in daylight. Because the playbook only works in the dark and the rush. Slow it down, light it up, and half the musts turn into maybes. That's where cities get leverage back. That's where the future stops being a discount rate and starts being a choice. Countermoves, cities that said no or set terms. So after all that, who pushed back and actually kept control? A few places drew lines and lived to tell it. Start with a boring hero, cheap public money. States run revolving funds, low-interest pools for water, sewer, and even storm projects. Cities that tapped those instead of private concessions kept rates lower and policy-free. They paired that with public-public partnerships. A stronger utility helps a weaker neighbor, share crews, share purchasing, ditch the middleman. Not flashy. It works. Some councils also killed the forever lease. They wrote shorter concessions, 10 to 20 years, not 75, with real clawbacks. If service slips twice, the city steps in. If returns beat a hurdle, rates step down or profit shares back to a community fund. Operators hate it. Residents love it because they see upside and a timer. Performance KPIs went from brochure talk to binding law. Not just keep the lights on. Specifics: outage minutes per customer, leak loss targets, repair response hour clocks, ADA access scores, customer credit auto triggers. Miss a metric, bills drop automatically. No begging for refunds. The operator pays in credits, not PR. Then revenue sharing above returns. Cities set a base return, say 9%. Above that, the extra splits, 40% to the operator, 60% to the city, earmarked for parks, transit passes, and bill relief. Suddenly, inflation isn't just pain. If it boosts returns, residents see checks or lower fees. The politics flip. Sunlight clauses made a difference. Post draft contracts and redlines 30 days before any vote. Publish the model assumptions, traffic, meter turns, break rates, in plain English. Real data access in the contract. The city gets raw feeds, not annual PDFs. A public dashboard shows rates, performance, and complaint backlogs. When everyone can see, games shrink. One city built a municipal bank function, small at first. A treasury office carved out a lending arm for bridge finance. Short, transparent loans to replace shadow bank panic paper. Rates a bit higher than state pools, way lower than private credit. Covenants simple. No lockbox on everyday life. It saved them twice when markets wobbled. On fees, a few places banned securitizing fines and barred private probation. Courts stopped charging user fees for justice. They moved costs to the general fund, capped add-ons, and set income-based payment plans with zero interest. Compliance improved, collections stayed steady, and the human damage dropped. Trust is an asset too. Targeted taxes beat backdoor fees. Instead of jacking water-based charges, cities passed narrow, voter-approved levies for pensions or resilience. Small, sunset, audited. Pain was shared, transparent, and progressive. No shut-off threats. No boot trucks. People will pay for things they can see and vote on. There were smart carve-outs, too. Contracts wrote in policy freedom. Safety projects, bus lanes, outdoor dining, festivals, climate emergencies, lifeline shutoff protections, all exempt from compensation. Operators priced that up front. The city bought flexibility on day one, not at arbitration on day 1,000. Data and audits changed tone. Citizen audit boards got a veto window, 30 days after posting terms to flag tricks in the fine print. Peer reviewers, retired engineers, union leads, small business owners, sat with the binders. They didn't stop every deal. They stripped the gotchas. A clause here, an index there. Millions saved by a red pen. Here's a micro-story. A river city needed a new plant. Instead of selling water rights, they issued green bonds through a state program at low rates, tied to leak loss cuts and energy savings. The contractor's bonus depended on real utility bills dropping. 3 years later, leaks fell, bills stabilized, and the bond coupon stepped down. Residents saw it on their statements. Performance credit. Small line, big message. Another place rewrote parking. They kept ownership, hired an operator on a fee-for-service with a gain share. Better collections? Split it. Price changes? Council vote only. Festivals, bike lanes, and transit pilots sat on a protected list. Yes, meters got smarter, but the street stayed public. When the city closed blocks for restaurants in 2020, no. Invoices arrived. Just tables and tips. And about advisors, one city flipped incentives. Consultants got a small retainer up front, then a tail paid over 5 years tied to customer satisfaction, outage metrics, equity benchmarks, and the city's net position. If a deal aged badly, their pay shrank. Suddenly, the deck included "don't do this" slides. Imagine that. Will Wall Street skip cities with guardrails? Some will. Many won't. Capital chases yield, and clear rules lower real risk. Funds priced the new terms, cut the leverage a notch, and still showed up. Meanwhile, the public saved itself from the worst traps and kept the right to steer. Let's be honest. None of this is free or easy. Sunlight slows things. Guardrails raise prices a little at close. But you're buying freedom with dollars you can count. That's cheaper than paying rent on your own curb for 75 years. The move isn't to say never. It's to say on our terms. Public money first. Short clocks. Share the upside. Protect the essentials. Publish everything. And if a deal can't live in that light, let it walk. Another will come. Your block will still be here. Personal action plan. Protect your wallet and your street. Alright, let's get practical. You can't rewrite old contracts tonight, but you can stop leaking cash and help steer new ones. Start with your bills. Grab water, sewer, trash, transit, parking app receipts. Circle weird lines, CAPEX recovery, system upgrade fee, processing, service charge. If you see a rider that grew fast, call and ask what it funds and when it ends. Put dates on a calendar. If it's permanent, note it for public comment later. Now kill avoidable charges. Prepay transit passes when there's a discount. Split a monthly with a coworker on alternating days. If you drive, map free or low-cost parking zones a few blocks from your usual stop. Set phone reminders for street cleaning days so you don't feed boot trucks. For meters, use the app but turn off auto extend. Those last 15 minutes add up faster than you think. On water, hunt leaks. One dripping faucet can add a stealth fee tier. Check your meter at night. If the dial moves when everything's off, you've got a ghost leak. Ask for a free kit from the utility. Many offer dye tabs and low-flow tips. If your bill jumps after a CAPEX rider appears, ask for the tariff sheet and appeal options. Get this, some utilities quietly offer one-time leak forgiveness. You have to ask. Build tiny buffers. Set a sinking fund, $10 a week, for tickets, tolls, or surprise fees. It's not fun, it's armor. If a ticket lands, pay or contest fast. Late fees are the profit engine. Take pictures, pull signage on Street View, bring timelines. If you win once, you'll never miss a deadline again. Trust me on this one. Now, zoom out from your fridge to City Hall. Subscribe to your council's agenda emails. Scan for words like concession, lease, public-private partnership, revenue-backed, lockbox, securitization. If a hearing pops up at 2 p.m. on a weekday with a 300-page packet, that's a tell. Email your member and ask for a 30-day posting rule and a plain English term sheet. Keep it simple. Term length, escalators, change in law math, arbitration venue, data rights, termination fees. If they won't post it, they shouldn't vote it. Kill the holiday sprint. Organize 3 neighbors per district to call when emergency votes show up near year-end. You don't need a mob. 10 calls beat 1 viral rant. Ask for independent valuations paid flat, not by closing. Ask for competing bids, including a public option from state revolving funds. Say these words: shorter term, profit sharing above a hurdle, carve-outs for safety, festivals, bike lanes, lifeline shutoff protections. Make them write those in the first pages, not Annex J. Protect lifelines. Push for income-based utility rates and a real winter shutoff moratorium baked into law, not a press release. Ask your utility to auto-credit outage minutes, not make you apply. And ban securitizing fines. Tell your council, don't turn my mistakes into a bond. Courts should be funded by all of us, not the poorest of us. If your town uses private probation, push to end it. No joke, shutting that pipeline saves lives and steady cash. Build local leverage. Start a neighborhood parking solidarity chat. Share free blocks, broken meter pics, street cleaning maps, and tow alerts. One text can save 10 tickets. For commuters, coordinate toll carpools and off-peak runs. If you cross a plaza daily, run the math on monthly transponders or employer stipends. Ask HR for pre-tax transit and parking benefits. Lots of companies forget. Been there, done that, it's found money. Microside hustles help too. If rate hikes bite, aim for one tiny income stream that matches the bill line you hate. Water up $10? List a tool on a rental app twice a month. Parking spikes downtown? Offer a driveway spot during events. It's not glamorous. It blunts pain. You're buying back choice with small, steady moves. Let's be honest, this is how you take control while the big fight runs. Now make noise with receipts. Snap your bill, circle the rider, and tag your council with a question, not a rant. When does this end? Where's the data? Invite a reporter. Local outlets love clear, human proof. Host a 10-minute contract club at the library. Bring coffee. Split pages. Translate. People show up when they see their bill in the fine print. Join or start a citizen audit board. You don't need to be a lawyer. You need highlighters and stubbornness. Ask for raw data access clauses and public dashboards in every deal. Push profit-sharing tied to refinancing. If an operator harvests gains, your city should too. And ask for shorter clocks, 10 to 20 years, not 75. Long paper is where freedom goes to die. Last piece, build a buyback jar. Neighborhood foundations, credit unions, churches seed a small fund aimed at future terminations or step-ins. It sounds big. Start tiny. When the moment comes, you'll have more than outrage. You'll have a check. Investors respect cash. You can't stop every deal. You can raise the price of bad ones and boost the odds of good ones. Read your bill. Kill junk fees. Show up early. Demand sunlight. Share upside. Protect lifelines. And talk to your neighbor like money flows on your block, because it does. Take control, one line item at a time. Then scale it to City Hall. Let's get global money behind your block. Zoom out for a second. The cash behind your curb isn't just local banks and a few funds. It's global. Sovereign wealth from the Gulf. European insurers. Australian pension giants. Mega infrastructure funds with 20-year horizons and teams who read contracts like cookbooks. They don't chase headlines. They collect cash flows. Your tap, your toll, your meter, those are their favorite bonds with better stories. Why do they love this stuff? Predictable, monopoly revenue with inflation baked in. If a deal links fees to the consumer price index, that's gold for an insurer who owes retirees in the 2030s and 2040s. A tiny bump each year, compounding forever. They don't need drama. They need certainty. Your street gives it to them. If the paper is tight, cross-border rules sweeten it. Many deals sit under foreign law or use holding companies in places with friendly tax treaties. That means dividends cross borders with lighter taxes and contract fights land in venues the investors know. They call it risk management. Cities feel it as distance. When a mayor wants to tweak hours or carve a bus lane, the counterparty lives 12 time zones away and speaks through lawyers. Tax architecture matters too. Some funds pair assets with depreciation plays or use interest deductions to lower taxable income. They're not breaking rules. They're threading them. If a utilities upgrade plan is big, the capex becomes both a justification for rate hikes and a tax shield in some structures. It's tidy finance. On your bill, it's a system improvement fee. ESG sits on top as a fresh label. Environmental, social, governance. Those three letters now wrap a lot of sales decks. A water plant becomes resilience. A toll road camera upgrade becomes safety. A meter app becomes access. Some of it's real. Better pipes save water. Safer roads save lives. But watch the math. ESG doesn't erase the escalators. It can make them look noble while they rise. Climate is the biggest fee story you're not watching. Flood pumps, sea walls, wildfire hardening, stormwater tunnels. This is the next multi-decade build-out. It needs capital. Private funds line up because resilience spending can be tariffed for decades. Add a climate recovery rider and lock it for 30 years and the model sings. Cities absolutely need resilience. The question is who sets the price path and who shares upside if costs fall with tech. Here's a microstory. A coastal city signs a stormwater concession with a global fund. New bioswales, bigger culverts, backup power. It works, streets flood less. The tariff includes an annual inflation bump plus a tech upgrade rider. 5 years in, sensors get cheaper and smarter. Savings show up, just not on bills. The contract pays the operator the same, while actual costs drop. Without a profit share clause, residents don't see the win. Sovereign and pension money also brings a patience local politics can't match. A fund can wait 10 years for break-even, then harvest for 65. A mayor stares at 4. That mismatch shapes outcomes. When negotiations stall, the fund shrugs and holds. The city blinks because payroll is Friday. Leverage isn't loud. It's calendar math. Now, not all global money is the same. Some funds are direct, long-only, low leverage. They like stable, public-facing partnerships and don't push every clause. Others run heavy debt, flip assets after de-risking, and squeeze covenants hard. The logo doesn't tell you which one you're courting. The term sheet does. If you see lockboxes, step-ups, and change-in-law teeth, you're with the second kind. There's also treaty protection. Certain investors use bilateral investment treaties to claim protections if a government expropriates value through new laws. That doesn't mean they win every time. It means they get a seat in a forum your council never visits. A carve-out for safety and equity in the contract can block some of that. If you didn't buy that carve-out, you'll meet it later with counsel. So what do we do with this reality? Set rules that travel as far as their money. Standardize plain English term sheets across states. Mandate revenue sharing above a return hurdle so inflation upside doesn't fly overseas without a cut for the block that pays. Cap escalators below consumer price index in recessions. Bake in climate carve-outs, emergency orders, lifeline protections, safety lanes, exempt from compensation. Use public capital first. State revolving funds, green bonds with performance step-downs, municipal banks for bridge finance. Private money should be the last mile, not the first. And when you do bring it in, write data rights and transparency into law. Real-time dashboards. Open audits. Sunset reviews. If a fund wants your street, it can live in your light. Because ending stake is simple. If we don't set the terms, they will. Global money isn't the villain. It's a force. It flows to yield and structure. Write better paper. And that force builds the world you want without turning your block into a dividend you can't vote on. What changes if we change the terms? So here's the switch. We stop selling tomorrow for headlines today. We write paper that serves people first and lets capital earn a fair, boring return. Control the contract. Control the cost of living. That's the whole ballgame. Start with the one rule that resets power. Ban ultra-long leases. 10 to 20 years, not 75. Short clocks force better service because a renewal is never far. They keep counsels in the driver's seat. And if the operator crushes it, fine. Renew on terms that share gains, not just risk. Hard cap the escalators. Tie them to consumer price index with a collar. Below in recessions, at or under in normal times, never above. Add lifeline tiers that cut base charges for low users. Make caps real with auto credits on bills, not apply and wait vouchers. If inflation spikes, people still eat. Mandate revenue sharing above a return hurdle. You want investors to do well, sure. But when returns beat, say, 9%, the extra should flow back to residents or drop rates. Put it on a schedule, paid every year, shown on bills as profit share credit. If efficiency and refinancing juice the model, the block that pays sees the win. Kill the gotcha clauses or fence them in. Non-compete? Carve out safety, bus lanes, bike lanes, festivals, climate emergencies, and lifeline shutoff protections. Change in law. Price a fair basket up front and cap payouts. Mandatory arbitration? Fine, but keep venue local and records public by default. Data rights? Real-time access for the city and public dashboards in plain English. Debt hygiene has to grow up. Set rainy day targets in law. 1 to 2 months of spending, no excuses. Fund pensions on a schedule that matches promises, not polls. Ban pension obligation bonds unless voters approve with full risk sheets. You don't leverage grandma's check without consent. Stand up public option finance. State revolving funds first. A municipal bank or lending window for short bridges, with clean covenants and no lockboxes on everyday life. Private credit becomes a backstop, not a lifeline. If speed is the only argument, build public speed. Standardize the term sheet. 1 page, 5 boxes. Term length, escalators, compensation math, data rights, termination costs. Post red lines 30 days before any vote. Force real auctions with time for counterbids, including a public bid. Advisors get paid flat plus a tail tied to 5-year outcomes, customer credits, outage minutes, equity metrics, city net position. If a deal ages badly, their check shrinks. Write performance into people's bills. Outage, auto credit, slow repair, auto credit, dirty water notice, auto credit. Don't make folks beg. Tie operator bonuses to those same metrics with penalties that beat press releases. Protect the essentials from securitization. Ban bundling court fines, tickets, and basic lifelines into bonds. Justice isn't a side hustle. If you need cash, raise it in daylight, not on the backs of people who missed a meter. Add republic levers. Step-in rights after 2 misses on core KPIs. A price list for data, software, and maps if the city takes back ops. A termination reserve you build over time, so a buyback doesn't gut libraries. Publish that reserve every budget season, so the public sees the plan. And yes, charge what it costs when it's fair. If resilient spend is real, ring-fence it, cap the term, and share upside if tech gets cheaper. Green bonds with step-down coupons tied to leak loss cuts and energy savings turn we promise into we paid. Will capital still show? Of course. Predictable, inflation-linked cash with clear rules is catnip. The difference is who writes the rules. Set terms that protect the right to steer and split the gains. Your life gets steadier, your bill gets saner, and your mayor stops fearing the mail. That's the turn, not anti-money. Pro terms. City as steward, not distressed seller. If the future is a contract, then make it a good one. Every time you park, tap, flush, or drive, someone gets paid. It should fund your city's choices, not someone else's dividend. Want more control? Share this with a neighbor. Tell your council to post draft terms 30 days early and subscribe. Next up, we dig into the insurance angle, quietly bankrolling these deals. Take control of your block's cash flow. Let's get hustling.